If you've ever heard stories about people making ridiculous triple and four-digit gains in the stock market and then proceeding to lose all of it within the span of a day, you've probably heard about options traders. So, what are options and why are they so insanely volatile? Well, an option is just a contract that controls assets. In this case, we're going to be focusing on stock options. An option comes into existence because someone writes it up. Writing a stock option and selling a stock option are synonymous with each other. So there is someone just out there authoring these and then proceeding to sell them for money. And once they're sold and on the market, other people can trade with them back and forth, and the value of them varies a lot. So what sort of things are in these contracts? Well, every stock option contains a date that it expires on, a strike price, which is any possible price of the stock, and then how many shares it controls. For almost all cases, it's going to be 100 shares. However, there are some cases, like with stock splits, where that gets modified. To give an example using everyone's favorite meme stock, let's say we had a Tesla options contract. It would have some sort of expiration date, let's say October 23rd, 2020. It would have a strike price, let's go with 420, and then it would control 100 shares, which would be $42,000 at that strike price of 420. There are two different types of options contracts, puts and calls. A put is a contract that gives the owner of the contract the option to sell 100 shares at the strike price on the contract. This is a bearish position. A call is a contract that gives the owner the option to buy 100 shares at the strike price. This is a bullish position. Options originally came into existence in order to hedge positions, primarily. Let's say you own tons and tons of a stock that is rather volatile and there is big earnings coming up that could make or break the company. Well, instead of selling all your shares, you could buy a couple puts so you can essentially lock in a sell price in case it dips big time. And that way you can minimize your maximum loss. And let's say the opposite is true. Perhaps you expect a stock to absolutely skyrocket in value and you want to lock in a specific price. You could purchase a call option. As mentioned before, when someone writes up an options contract, they can simply sell it for money, which is known as premium, or they could use it in other strategies. Now, if any of this isn't making sense to you, or any of it is confusing, don't worry. I'm going to go through some visual examples later in this video. When you sell an option, the opposite of buying an option occurs. So if you sell a call option, you are on the hook to sell 100 shares of a stock to the option holder if they choose to exercise. Keep in mind that if you don't actually own 100 shares, then your maximum risk is theoretically infinite, because if the stock soars in value, there's no upper limit for the stock, and you have to obtain 100 shares on the open market. If you sell a put, you will be on the hook to buy 100 shares from the options holder if they choose to exercise. In both cases, you do collect a premium for selling the options contract, but naturally, the holder of the contract will only exercise if it's profitable for them. So you really don't want your contracts to be exercised if you plan on making money with them. And with a put, your maximum risk is the strike price on the options contract. Because if a stock falls to zero, the holder of the contract can still force you to buy a worthless stock at the strike price. So because of this, there are different terms associated with selling options and buying options. If you sell a contract, you are selling to open and you're collecting premium. However, as mentioned before, you're on the hook to buy those 100 shares when it expires if the owner wants to exercise the option. If the shares don't dip below the strike price, it doesn't make any sense to exercise the option because you could just sell your shares on the open market for more. And it's the same thing with a call option. If the stock does not exceed the strike price, it makes no sense to exercise it because you could simply buy the stocks on the open market for cheaper. As mentioned before, when you're selling, there is an obligation you have to meet. Once you sell to open, the only way to cancel things out is to buy the identical contract that you sold in order to close out of your position. Because if that's exercised, you simply exercise the one you own, and they cancel each other out, essentially. So that's why we have the terms sell to open and buy to close for selling contracts. With buying, it's a similar story. You buy to open, and you own this contract. If you want to get rid of this contract, you have to sell to close. And then there's strategies that make use of both of these simultaneously, such as spreads. That's not going to be the focus of this video. I'll have another video in the future talking about spreads and strategies like that. But they generally involve a mix of buying and selling numerous contracts in order to achieve some sort of endgame. Then obviously you get the question of what happens if the strike price is never hit. Well, if the strike price is never hit, then the option is going to expire worthless. In the case of a put, you want it below the strike price. In the case of a call, you want it above the strike price. Any other scenarios, it doesn't make any sense to exercise those options, other than select opportunities, which I'll discuss in a later video. So that option expires worthless. And that person we talked about at the beginning of the video, writing up these contracts and selling them, he gets to keep all of that premium without ever having to worry about supplying you any shares. Now, if that sounded strange to you, don't worry. Options are weird because they don't reflect the actual value of the stock. They are a derivative of the stock value and likely outcomes of that stock value. To make things more visual and easier to understand, I'm going to be using Options Profit Calculator, which is a great tool you can find online. This will show you the money you can get from options and how the price changes. Let's start with the call option we talked about. The ability to buy 100 shares of a stock at a select strike price. In this case, I'm going to go with Tesla since it's everyone's favorite meme stock. And we're going to buy one option. For the price of the option, we're going to select the option. And in this case, I'll go a little farther out. Let's go the 18th of December. These are the different strike prices you can select. When it comes to bid, mid, ask, don't worry about these too much. Bid is simply what people willing to buy the contract are bidding, and ask is simply the people writing and selling the contracts, what they're listing the price as. And then the mid price is just in between those. So currently Tesla's trading for $420.60. Let's say we are very bullish on Tesla and we expect it to rise in price by then. Let's go to a $450 option, and then we can just select the mid price to make things simple. So we have an 18th of December $450 call for Tesla. And the price per that option, what they're trading for, is this times 100, which is $2,988. So if we calculate our graph, we get the profit to loss. And this should be in line with what we said. Calls don't make any sense unless you expect the asset to go up. In this case, as the asset increases in value, we make money, assuming it increases enough. If the stock just stays flat and we get all the way to expiration, it's going to be completely worthless. The options contract we bought for $2,988 is not going to be worth anything. And that is right where our strike price is. Remember, it was $450. So if it's $448 at expiration, the contract is worthless. Now, if it's $452, that's good because that's higher than our strike price and we can buy them cheaper than shares on the market. However, you have to remember we paid almost $3,000 for that. So the $2 higher minus what we cost means we're making $200, but we spent $3,000 to make $200. So that's not particularly good. And as you go up, it gets better and better. In order to actually make profit, we would have to reach a stock price of $480 due to how expensive this call is. And we would make a profit of $12. And if it goes to 484, we would make $420. And if we increase the boundaries of this graph, we can see that options essentially have an infinite amount of gain. And we can see 375% gain, 402% gain, massive, huge increases. Triple-digit increases in the value of our option, triple-digit profits, when we only have double-digit increases in the stock price. Now, of course, the possible losses are pretty huge. The contract you spend all this money for becomes completely worthless. And the reason all of these values are associated with dates, and we see this strange line appear, is because as you get closer to the expiration date, the probability of the strike price being hit gets more or less likely. Think about it. If we expect Tesla to hit $450 and we buy this contract and it continues to soar up in price, we could actually sell that contract before it expires for a lot of money. Or we could exercise it early and also make a decent amount of money. However, if Tesla declines, that contract is not going to be worth a lot. And if it stays down there and gets closer and closer and closer to the expiration date, the contract is almost completely worthless, maybe only worth $1 or $2. And the reason for that is, in order to go all the way up to the strike price, you're going to need a huge, massive surge in price right before expiration. And the reality is that's not very likely. So, because of that, your contract becomes worth way less than what you bought it for. Now, I mentioned what it's like to buy options. Let's go over selling options, or at least show what a sold option chart looks like. In this case, let's select Tesla. And remember, the inverse happens whether we select a call or put. So we're choosing the 18th of December. And in this case, we're going to choose a call. Let's do $450. If Tesla goes above $450, we lose money because the options contract holder will exercise. If it is below that, we make money. Although if you noticed, around $450, it still says we're making a profit here. Not maximum profit, but we're still making a lot of money. The reason for that is because we collect a premium when we sell an option. So, even if we're forced to buy shares on the open market and sell them at a lower price, we won't make maximum profit, but we'll still make some money. It's only until we get to more extreme values that we risk losing money. And in the case of a call, there's an infinite amount of risk because there's no upper limit for the stock. If we change our boundaries, we can see that it just keeps getting worse and worse and worse, even though there is a maximum profit we can make. In the case of a call, if the stock price is above the strike price on the call, that call is in the money. If it's below the strike price, it's out of the money. And the opposite is true for a put. If the price of the stock is below the strike price on a put, then that put is in the money. If the strike price is above the value of the put, that put is out of the money. To make things simple, if an option makes sense to exercise, it's in the money. If an option doesn't make any sense to exercise, it's out of the money. Let's do something similar for a put. Let's select Tesla. We'll buy a put. We'll do the same date of the 18th of September, and we will utilize the same stock price of $450. In this case, on this website, puts are on the right-hand column. So let's just select the mid price. That's a very expensive put. and we will calculate the range. And as you can see, the put is the exact opposite of a call. If Tesla stays below that strike price, we're going to be making a lot of money because the put allows us to sell our stock at that strike price. If the strike price is $450 and Tesla's trading for, let's say, $400, well, that's a pretty huge difference. You're selling way above what the current value of the asset is. However, if Tesla skyrockets, well, your contract is completely worthless because you could just sell your stock on the open market and make way more money. And these extreme changes in valuation and the fact that something you purchased can go to zero, well, that's what makes options so incredibly volatile. Yes, it's completely possible that a stock goes to $0. It completely plummets in value. But that's not extremely common, especially when you start talking about established companies. Generally, you won't see 100% loss on a stock. But with options, it's very common to see that. In fact, if you look at options data, you'll see, at least for these years when we had data, over 76% of options expire worthless, which means a lot of people are buying things and losing money. Although you need to understand, as we mentioned before, a lot of times options are purchased to hedge bets. If you own a lot of a stock, you want to minimize your risk. And many times it makes more sense to purchase options rather than just sell the asset, especially if you're uncertain about the asset. If you think it might go up, but you want to hedge any possible risk if it goes down. Now, I won't get into a whole lot of detail on spreads, so I'm going to go through this pretty quickly, but a spread involves multiple usages of options, and each of those are called legs. If you're dealing with two different options contracts at once, that's a two-leg strategy, and it can go up to a theoretically infinite amount of legs. This price chart is an example of a put spread. You're essentially selling an option, but also buying an option to hedge your maximum risk. So instead of the thousands and thousands of dollars that you could potentially lose buying a naked call or put, instead, your maximum risk is $202. But your maximum return is also capped, unlike a naked option, where our maximum return is almost $300. And we can see our profit chart has changed pretty intensely. Now, all of our red is down here, all of our green is up here, rather than this diagonal chart. And these different combinations will give you different results here. So it all depends on how you think the stock will move, and then you generate a different chart using a different strategy to meet what you think will happen. If you want to jump into the stock market and start investing, I have a referral link in the description for Webull. If you sign up, you'll get 2 free stocks and have access to a fantastic mobile and web app.